You're 67. You pull $1,000 from your retirement account. The tax bracket says you owe 12%, $120. The real bill? $222. Same withdrawal. Almost double the tax. Nobody warned you, because this trap has a name the insiders use, and you don't, the tax torpedo. Here's the answer before we climb the ladder. The torpedo is not some new tax. It's a rule the IRS still runs from 1983 and 1993 that Congress never adjusted for inflation. Because of it, each extra dollar you withdraw in retirement can drag 50 to 85 cents of your Social Security check onto your taxable pile. So the rate you actually pay can be nearly double the number printed on your bracket. The good news: the fix isn't whether you take the money. It's when. Stick with me, this is the map. Quick note before the numbers. This is public math, not financial advice. Run your own numbers and talk to a tax professional before you move real money. Stage 1. You're retired and your income is low. First, the key term, provisional income. The Social Security Administration adds up your regular income, any tax-exempt interest, and half of your Social Security benefit. If that total lands under $25,000 filing single or $32,000 married, congratulations, 0% of your benefit is taxed. This is the calm water. And notice, Roth withdrawals and your cash savings don't even show up in that formula. End of Stage 1. Provisional income under $25,000, tax on your Social Security $0. Stage 2. You want a little more. An IRA withdrawal, maybe a part-time paycheck. You cross $25,000 single, $32,000 married. Now the torpedo arms. For every extra dollar of income, up to 50 cents of your Social Security gets pulled onto the taxable pile right beside it. Your 12% bracket quietly starts behaving like 18. You didn't get a raise. You got a multiplier. End of Stage 2. Cross $25,000, and your 12% bracket acts like 18%. Stage 3. You keep climbing. Above 34,000 single, 44,000 married, you hit the top tier, and now up to 85 cents of Social Security follows every single dollar you pull. Watch the arithmetic. You withdraw $1,000. That withdrawal creates $850 of newly taxable Social Security. So 1,000 real dollars becomes $1,850 of taxable income. In the 12% bracket, your true rate is 22.2%. In the 22% bracket, it is 40.7%. Fidelity literally calls this the tax torpedo, and Stage 3 is the warhead. To be clear, up to 85% of your benefit becomes taxable income. It does not mean the government takes 85% of your check. End of Stage 3. Withdraw $1,000. Get taxed on $1,850, a real rate up to 40.7%. Stage 4. Here's the part that should make you angry. Those lines, 25,000 and 34,000, were written in 1983 and 1993 and never adjusted for inflation. Not once. That's more than 40 years of inflation the threshold completely ignored. In 1983, a first-class stamp cost 20 cents. Postage has more than tripled since, but the threshold has not moved a single dollar. The gap is now big enough to pull ordinary retirees into a trap that was originally sold as a tax on the wealthy. And that 2026 headline about no tax on Social Security? Read the fine print. The One Big Beautiful Bill added a temporary $6,000 senior deduction through 2028. It softens the blow for some, but it does not repeal the torpedo, and it phases out above 75,000 single, 150,000 married. End of Stage 4. Thresholds frozen 40-plus years. Benefits still taxed in 2026. So here's the turn. The tax torpedo isn't really a tax rate. It's a timing problem. The dangerous years are after you claim Social Security. The opportunity years are before. In early retirement, before you switch on your benefit, and before required minimum distributions hit at 73, your provisional income is naturally low. That is your window. Convert traditional dollars to Roth, or take your taxable withdrawals up to the edge of the next threshold, and then stop. You fill the low brackets on purpose now, so the torpedo has nothing left to hit later. Now the honest counterpoint. For a lot of middle-income retirees, the torpedo is real but modest, and it does cap. No more than 85% of your benefit is ever taxable, so the damage tops out. And converting too aggressively has its own traps, like pushing your income high enough to trigger higher Medicare premiums. So don't let the tax tail wag the dog. The answer isn't panic. It's sequence. The one thing to remember, it is not what you withdraw, it's when. The bracket on paper is not the rate you actually pay. And again, this is public math, not financial advice, so run your own numbers with a professional before you move real money. If a rule frozen since 1983, quietly setting your tax bill, is the kind of thing you want decoded, there's a new working theory here every night at 7. Then tell me in the comments, should Congress finally index these thresholds to inflation, or is the torpedo doing exactly what it was built to do?